why go abroad? I mean, is there a need to be global at this point when there's this sort of inflection point in the U.S. energy industry? Tim, do you have, I mean, y'all do invest globally, but how's the portfolio breakdown?
Look, I think we're at kind of a special time in the energy business where there are opportunities globally. Right. Clearly, the opportunities in North America probably haven't been better for probably 20 years. That being said, there's still incredible opportunities internationally. I mean, we're in large, deep water exploration plays in Brazil, West Africa. We're in Asia looking at development plays in gas. Those are all very interesting, good opportunities. When you look at some of the larger equipment plays, you're going to end up looking at some of the mainstay companies in Western Europe that may have manufacturing over in China and Asia. And so, you know, we definitely see it as an international opportunity, but that's not to say that the U.S. opportunity isn't fantastic in its own right, because it is.
Now, Dan, you guys did some investment in Europe, but are sort of mostly focused on the States. When you look at well, let's talk about North America for a little bit. When you think about the North American energy opportunity, where are y'all putting most of your capital to work now?
I mean, I think right now the biggest opportunity out there is the midstream. Right. So, you know, it's pipes, gathering, processing, storage. That's where the big dollars can be deployed. It's a big market. I think, you know, one of the things we talk about competition, what I always liked about energy is it's really big. I mean, there isn't a bigger energy, you know, user of capital in the energy space. Right. So it's big, it's pretty complicated. So it creates barriers to entry for sophisticated investors need to go in and figure out where to get value out of that and sort of sort through this big space. So I always liked that about the energy industry. And if you think about midstream, it's got something for almost every kind of investment fund out there. And I do think some people are underpricing levels of risk, but you can take all the sort of commodity risk you want. If you're going to go build out infrastructure and hope the commodity comes to you, and you're going to have to figure out what the cost of extracting those hydrocarbons are in a given basin, how they're going to be delivered, how they're going to be processed, or you can wait for someone to do the whole thing and sell it down at a pretty nice return. And that's where I see the opportunity for us is really, we've got a pretty granular approach to the space. We bring a lot of knowledge around the commodity, around the construction and operation of these assets, and if you can de-risk them, there's a lot of people who are looking for long-dated, sort of yieldy, even 8, 9, 10% deals out there. So I think there's a role for almost everybody in the midstream space right now.
Somit and Dave, would you disagree? I mean, where do you sort of balance the portfolio between upstream, midstream, downstream?
We've got a pretty diverse mix, actually. I think the bulk of it, maybe 40% is upstream, a third power, and then everything else from a vertical standpoint. I think the international diversification is very important. And for us, a little less than half of our investments have been U.S.-based, and the other half overseas, and quite a few of those in emerging markets. In Africa, in India, we're doing power and oil exploration in Africa. We're a large solar developer in India, and we're doing a power plant in the Philippines. So we are pretty much all over. And it's important, though, that you don't let the scope lead your own resources and capabilities, because you can definitely get out of your league pretty quickly in some of these foreign markets. We have the benefit, being part of a larger firm at Blackstone, the larger private equity group that the energy business exists within, that we can rely on Blackstone private equity resources in those home markets. So when we're doing a deal in India, it's the energy team combined with the resources of our Mumbai office, and I think that gives us some advantages. And it's a different type of risk profile. We try to mitigate that risk in how we structure the deal.
Now, Somit, are you guys spending more time in the U.S. now or more time abroad? How does the portfolio break down for you guys that way?
I would answer that by just saying we are, for the most part, geographically agnostic.
Right.
We really look at the investment opportunity. So even though we're still doing quite a bit of stuff in U.S., we've done 7 deals in Canada, put a couple of billion behind the 7 deals in Canada. We are in Africa, we are in Latin America, we've got deals in India, in China. And across that whole energy value chain, about 70% of that is E&P, and about 30%, is the midstream power stuff. Okay. So for us, we look at it much more from where do we see the right opportunity with the right risk reward.
One important thing from a portfolio standpoint is not all of the places that you invest within energy are correlated. So crude oil's pretty much a global commodity. There's the stuff that's locked in the middle of the U.S., which isn't entirely linked, but power is inherently local, and we find that gives us alpha, discrete alpha, that's not correlated with anything else, and they're not correlated with each other either. So as part of a broader energy portfolio, we kind of like having that.
Right.
And I would just add to David's comment there. I mean, if for us, if we don't see room specifically in the upstream space,
Right.
we'll play the whole commodity space around it. So
Right.
we are lead investor in a deep water commodity port in India,
Right.
which just gives us, just because we understand the whole energy space
Right.
and the value chain there, allows us to play along that whole energy spectrum.